Rarely is there a day so important that it determines the future of the stock market for the next 3 months. And this week, we have not one, but 2 days that will determine the direction of the stock market for the next 3 months. I'm Stock Curry. I'm a former Merrill Lynch and Morgan Stanley investment banker, and I have over 25 years of trading experience. And these days are very important to watch out for. It is very rare to have 2 days in 1 week that will determine the direction of the stock market for such a long period of time. As you probably already know, the stock market has been going up for the past year and a half, with the past 3 months seeing a major rally in stocks. And as you also probably know, that rally has been limited to just 7 stocks in the stock market for the most part. 7 stocks in the stock market over the past year and a half have gone up nearly 100%, while the remaining 9,000 stocks in the stock market have traded pretty much flat. Those 7 stocks are the Magnificent 7, your 7 mega cap tech companies. And the reason that the S&P 500 and the NASDAQ have rallied so much over the past year and a half is not because the entire stock market's gone up, it is because those 7 stocks have gone up. Those 7 stocks make up 25% of the S&P 500 and 50% of the NASDAQ. And now, 6 of those 7 stocks are reporting earnings this week. Microsoft, AMD, and Alphabet are reporting on Tuesday, and Apple, Amazon, and Meta are reporting on Thursday. Now, you might be asking, what are these companies going to report for earnings? Are they going to beat earnings? Are they going to miss earnings? Are the stocks going to go up? Are the stocks going to go down? Certainly, anybody who wants to trade earnings wants to know this. And luckily, we don't really have to guess. We have a pretty good idea how these companies are going to perform based upon some companies that have already reported earnings earlier this week and last week. 2 weeks ago, Taiwan Semiconductor beat their profit and revenue expectations in the fourth quarter. Now, Taiwan Semiconductor beating earnings is kind of a big deal because over the past year and a half, the majority of the rally in the stock market has been due to AI hype, meaning stocks have been rallying up because of the hype around artificial intelligence and AI, and the biggest beneficiary of this AI hype has been the chip makers. Just like during any gold rush, some gold miners are going to hit it big, most are going to go bust, but it's almost guaranteed that those who sell shovels are going to make money. And during this AI hype, while some AI companies are going to hit it big, most are going to bust out, it's almost guaranteed that those who sell AI chips are going to make money. And that means any chip manufacturer, such as Nvidia, AMD, ARM, Intel, Taiwan Semiconductor, all of these should benefit from AI hype. So when Taiwan Semiconductor beat earnings, it was a huge boost to AI chips. The day Taiwan Semiconductor beat earnings, Nvidia stock rose over 4%. Of course, the stock rallied because investors were hoping that Nvidia would also beat earnings, causing Nvidia stock to go up as well. But even though Taiwan Semiconductor beat analyst expectations for earnings, does not mean that they reported good earnings. Taiwan Semiconductor reported a revenue decline of 1.5% from a year ago and a profit decline of 19% from a year ago. It's important to distinguish between a company beating earnings expectations and reporting good earnings. Analysts could be expecting really horrible earnings, and so long as a company beats those horrible expectations and only reports bad earnings, then technically they beat analysts' expectations. And that's exactly what we saw with Taiwan Semiconductor. They reported some pretty horrible earnings. Anytime your profit drops 20%, it's a pretty horrible quarter. And that's what Taiwan Semiconductor did. But because analysts were expecting even worse earnings than that, technically, they did beat earnings. Now, because AI hype is still strong, even though Taiwan Semiconductor had bad earnings, it still caused stocks like Nvidia and AMD and others to rise. And that's because Taiwan Semiconductor's earnings have a really important meaning for some stocks, including Apple and Nvidia. Taiwan Semiconductor counts Apple and Nvidia among its biggest clients. So when Taiwan Semiconductor beat earnings, it meant there was a really good chance that Apple and Nvidia were going to beat earnings expectations also. And this is one of the main reasons why we've seen Nvidia rally so much over the past 2 weeks, is hope that Nvidia is going to beat analyst expectations once again, and the stock is going to continue to go up. Now, there's no doubt that there's a lot of hype and FOMO around Nvidia stock right now. The question is whether that rally that we've seen over the past few weeks is justified or not. We'll talk about that in a minute. But one thing that we have to understand is that Taiwan Semiconductor isn't the only company that reported earnings already. Another company reported earnings on Friday, and that was Intel, another chip manufacturer. Like Taiwan Semiconductor, Intel also beat analyst expectations with earnings at 54 cents per share versus only 45 cents per share expected, and revenue at $15.4 billion versus $15.1 billion expected. So with Intel also beating analyst expectations, you would expect that to have another boost in stocks and cause stocks to go higher, as well as Intel stock to rise higher as well. However, what you have to understand about the stock market is that the stock market really doesn't care that much about what happened in the past. What the stock market really wants to know is what's going to happen in the future. And some people believe the stock market is forward-looking by about 6 months. Some people say 12 months. Let's just go in between and say the stock market's forward-looking by about 9 months, which means when a company reports earnings, what investors are really interested in is not so much whether or not that company beat the analyst expectations for the past quarter. What people really want to know is, what is the company's forward guidance? What does the company expect to do next quarter and over the next 4 quarters? And unfortunately, Intel issued an outlook for the first quarter of 2024 that lagged analyst forecasts. Which means even though Intel beat analyst expectations last quarter, they're predicting sales to go down next quarter. Most telling, though, is that Intel's second biggest division, their data center and AI, saw sales decline 10% last quarter. And stock market investors did not like this at all. As a result of the bad forward guidance, Intel stock sank more than 10% on Friday. So of the 2 chip manufacturers who have reported earnings so far, Intel and Taiwan Semiconductor both reported a sales decline in their chips last quarter, and Intel took it one step further and forecasted an even worse quarter for Q1 of 2024. Investors did not like this at all, and it sent other chip stocks down, with AMD falling 1.7% on Friday and ARM falling 3.7%. Now, you may be saying, well, Scott, isn't this decline in sales already priced into the stocks? Aren't investors expecting that earnings are going to go down? So long as they beat analyst expectations, the stock should go up and continue to rise, right? Well, unfortunately, the decline in sales is not priced into stocks, with AMD reaching a PE ratio of 1,470. AMD is so overvalued right now, pricing in such incredible, impossible growth that one analyst actually gave AMD a heck if we know rating. The thing you have to understand is the Magnificent Seven stocks, especially the chip stocks such as Nvidia, AMD, ARM, and others, are in the middle of an AI bubble right now. And like all bubbles, they do eventually burst. During COVID, we saw a bubble in a number of stocks, such as Zoom, which rallied all the way up to over $580 per share. But the thing you have to understand is all bubbles eventually pop, and all stocks eventually fall back down to reality. Not only did we see this with Zoom, we also saw it with BNGO, Bionanogenomics, and NNDM, Nanodimension. Of course, 2020 and 2021 wasn't the only time we've had a bubble in the stock market. We also had a bubble during the dot-com era in the late 90s and early 2000s. That bubble also popped, as you can see here on this chart with Amazon from around the year 2000 and this chart of Apple from around the year 2000. Now, it's true, nobody really knows how long the bubble might last before it burst. The bubble during 2020 and 2021 only lasted about 6 months. The dot-com bubble lasted for almost 2 years. But eventually they do burst, and a lot of the stocks that people invested in 2021 ended up being down over 90% by the end of the year. A lot of stocks people invested in during the dot-com bubble also fell, with the NASDAQ eventually falling 80% from highs, and the S&P 500 eventually falling 50% from highs. Of course, this bubble is showing signs that it is also starting to burst as well. This is most notably seen in stocks like Tesla, which is down over 60% from all-time highs and continues to fall. Now, I'm not saying that stocks are guaranteed to fall this week. Obviously, if companies that report earnings this week are able to beat analyst expectations and give forward guidance that beats analyst expectations as well, then those stocks should rally. That's exactly what we saw with Netflix this past week, as it went up over 13% this week after it not only beat analysts' expectations for earnings last quarter, but also provided good forward guidance. Of course, the big difference between Netflix and a lot of other stocks is that Netflix is not running up at all-time highs and extremely overvalued. Netflix hasn't even reached all-time highs yet, even with the massive rally over the past week. And that means the stocks that are most likely to rally this week are going to be the stocks that are still beat down and have yet to join in on all the hype. Stocks like PayPal have a really good chance of going up this earnings season. Now, whether stocks go up or down this week, nobody really knows. I've given you the reasons why stocks might go up, and I've given you the reasons why stocks might go down. Regardless of what the stocks do, we can make money either way. As DWAC rallied last week, I bought a call option, and I made a 400% profit on DWAC last week. When Netflix beat earnings, I knew the QQQ was going to rise. So within 15 minutes of the market closing, I bought a QQQ call option and made a 198% profit on that overnight. And when Tesla missed analyst expectations and started falling back down to reality, I had a Tesla put option that I made a 347% profit on. Altogether last week, I made 8 trades. 7 were profitable, 1 lost. It ended up being an 87% win ratio with an average profit per trade of 157%. And if you want to make money like this in your portfolio, then come join me in my Stock Dads Discord, where I post all of my trade alerts. I'll teach you how to trade options. I'll show you exactly what I'm buying and selling. I post my trades within minutes of making the trades, so you can copy it and you can learn from my trades and you can make money with me. If you want to make money like this, come join me in the Stock Dads Discord at weprofit.io/stockdads. That's weprofit.io/stockdads.